Good morning, everyone, and welcome to another episode of the JBDC Virtual Biz Zone. Now, as you know, we have been doing our Access to Finance series, and this week is the third and final week in the series. And we want to thank all those persons who have joined us so far and are looking forward to this morning's presentation. This morning, I have with me Miss Leah Reid, and she is the program manager at Barita Foundation, and she's going to tell you a little bit about herself. But before we throw to Leah this morning, I just want to remind everyone that the session is being recorded, and we are going to have it available for you for persons who were not able to join or will be able to join us late. We will have those the session recorded for you, and you can always visit the JBDC page on YouTube at JBDC Jamaica so that you can view this session and all the other sessions that we have done in the Access to Finance series, or any of the other sessions that we have done over the period that we have been doing the JBDC Virtual Biz Zone. Also want to remind you that we're going to be posting our feedback form in the chat. We're going to ask you to, give us some feedback. Tell us how the session went for you. We always want to try to make the sessions better for persons who take the time to join us and to be with us every single Tuesday morning. We also want to let you know that we really appreciate it. We know that there are other things that you could have been doing, but the fact that you take the time to tune in on a Tuesday morning, we thank you so much, and we do not take it for granted at all. So as I said before, I have with me this morning Miss Leah Reid, and she is the program manager at the Barita Foundation. Now, Barita Foundation is one of our newest partners that has joined us so far. And Leah is going to be sharing with us on investing in youth entrepreneurship and the other part, wealth creation, which is something that all of us get excited by, because we want to do the things that are necessary so that even if we don't have the resources that we want right now, we can invest towards it. And so Leah is going to be giving us some very pertinent information this morning. I want everybody to tune in, pay attention, because I feel like this one is going to be really, really interesting, really, really informative, and really, really exciting. We invite you to post your questions in the chat. She has a colleague in the meeting room that will be helping her to answer questions during the presentation, and will also help her post the presentation. Ms. Shanique Williams, she's going to be giving support in the chat. So don't be afraid to drop your questions in the chat, and Shanique will facilitate those for you. So without further ado, I want to hand over to Leah. And as I said, Leah will tell you about herself and tell you about Barita Foundation, and then jump into the presentation. Leah?
Thank you very much, Sansia. And good morning, everyone. Welcome to this forum. We are going to spend a little while together this morning, and to ensure that you make the best of it, I would encourage you to get a pen, a piece of paper, whatever it is that you need so that you can capture the information. I feel like a bit of a hypocrite this morning, because on several occasions I have said to people, criticize other people's presentation and said, oh, them give so many information in one little session. It is a knowledge overload. But guess what? Sometimes we only get one time to talk to you. And because we only get one information, we just want to pull up and pour so many things, so many vital information into you at one time. And so because we know you're going to get a belly full today, what we're asking you to do is just take out your pen, get a little piece of paper, and write down the information so that you can go back to it and refresh your memory of the things that you learn. Now, JBDC and Barita, we've put a lot of effort into putting this presentation together just for you because we want you to succeed. It is very important for you to succeed. When we have more successful people in Jamaica, it makes life better for more of us. It means that more families have people in there that are doing good that will come back around to help them and to just make Jamaica a better place holistically. So I'm going to encourage you to bear with me for this presentation. If you have questions, you don't have to wait until the end and then you forget about it. Post it in the chat. My colleague Shanique Williamson, she's from Barita Investments. She is in the chat and she's there to support you, to answer your questions, give you feedback, and anything we don't know, we'll just take it down, get information, and get it right back to you. And so welcome again, everyone. It is going to be a jam-packed session, as I said. It is split in two parts. So we're going to talk about investments at first, and then we're going to move into talking about entrepreneurship. And then we're just going to tie up everything together. And so I'm going to bring up my presentation now. So here we go. Lovely. Ah, who is that beautiful girl right there? You shouldn't have seen that yet. All right, so let me know if you can hear well, if you're seeing my presentation. And
very well, Leah, very well. Loud
awesome, wonderful. And you're seeing my screen, good.
Yes.
So today we're talking about investing in youth entrepreneurship and wealth creation. And I want us to talk about just how to making money your business. So you might ask, what's your business? And you say, oh, I make jewelry, or I bake, or I do leather accessories. But what is it that you're doing it for? You want to make money at the end of the day. And when you make the money, you don't want to just spend everything. You want to make sure that it is your business. So you keep making more money, more money, more money. All right. So presenting this presentation is presented to you by the Barita Investments Limited, the Barita Foundation. I'm with the Barita Foundation, and that pretty circle in the middle, that's JBDC, Jamaica Business Development Corporation, who is making this meeting possible today. And I also represent the Cornerstone Company and the Cornerstone Trust and Merchant Bank. So we're one big family, and you're no stranger. No, you are part of the family too. So today your presenter is yours truly. I'm Leah Reid. And Leah is my first name. I used to think there was a hyphen in there, but RGB changed their mind about that. So Leah is just two words, like I'm Chinese, Ling Shung or Ching Yi. So it's Leah Reid. I'm the program manager at Barita Foundation. I am in my 5th year with the Barita companies. So I was the customer service manager at Barita Investments, and now I'm here, and I'm proud to say that Barita really makes money work for you. It is not a slogan that is just there to take up space on the wall. We actually do what we say that we will do for you. I've been an investment banking since May 2001. And I said May because May is a very special month. It is the best month in the whole year. And 2001, so I started in this business over 20 years ago. And I've held several positions in sales, operations, compliance, customer service, and all of that before I came into the foundation. I help money-savvy individuals manage their money and start investing. And if you wonder why I say money-savvy individuals, because you might think you're not money-savvy, the fact that you have taken the time to register, you took the time to log in, and you're here with us, that in and of itself tells me that you are indeed a money savvy individual. And I'm here to talk to you today about how to start investing, and how to make it work for you. And not only come in and keep it to yourself, send the link to your friends. As Sansia said before, we're streaming live on Facebook, so you can send the link to them so that they too can join in and benefit from the presentation. So today we are going to talk about what are investment products. I'm trying to minimize my screen so that I can see everything from my side too. All right. So we're talking about today, we're going to talk about what are some investment products. And that is first, because I know you're going to be wondering, oh, it's long time I want to know how stocks work, long time I want to know how this go. So we're going to get that out of the way first. And we're going to talk about why you should invest and how you should invest. We're going to talk about entrepreneurial framework and give you a little bit of tips right there too. And we are going to combine entrepreneurship and investment. So you see what I tell you, we are in this together today. I'm going to start my watch so I don't keep you the whole day, so I know when I'm talking like a bit too much. All right, so let's go. So what are the different types of investments? Whichever investment you have right now, one of them, it falls into one of these categories. So we're talking about growth investments, and these are more suitable for long-term investors that are willing and able to withstand market ups and downs. So whether you hear say the stock market making money or it now make money or this investment is up and down, that is called growth investments. So you have shares. And shares are also considered to be a growth investment, as they can help you grow the value of your original investment over the medium to long term. So when you hear about growth investment, think about grow. What does grow do? It gets more and more and more. So grow, you hear the talk right there about ups and downs, meaning that to grow, you have to take some chance. There's volatility there. And so that's number one and number two for you. We're going to come back to this slide, so take a note of it. You may not understand every single thing on it, but at the end of the presentation, I want you to have a clear idea as to where we stand with this. Number three, we're talking about defensive investments. So when you talk about defend, when you're watching football and you say, I remember years ago going to stadium, and when the reggae boys are playing, and you say, defend, defend, defend. I mean, that hype was so nice. I miss outside. So defensive investments, these are more focused on consistently generating income. There is a new word there, income, rather than growth, and are considered lower risk than growth investments. So here it is telling that when you're defending something, you're not going aggressively. You are in position, you're defending yourself. You don't want to take too much risk. So here it's saying that when you're in a defensive investment, it is guarding you from higher risk. So you're taking a lower risk. And if you're taking a lower risk, it means that your money is not going to grow as fast. So you see, so far we just start out and we learn growth already, and now we're learning about income. Right? When you hear about income, you're thinking about money that is coming to you. And I'm going to elaborate a little bit more on that as we go along as well. So cash investments, these include everyday bank accounts. So you see, I tell you, even the account that you get your pay in, your salary comes in, that's usually a cash account. So it's called cash because it's easy accessible. It's almost like having money in your pocket. And so your checking account, you can write a check, so it is also considered cash, and term deposit, like your CDs that you have at the bank. They typically carry the lowest potential returns of all the investment types. So if you have all of your pay and all of your money in a savings account or a checking account, if you read the lower part of number 4, it tells you that they typically carry the lowest potential return. Why? Because cash is accessible. Nobody can bill a shop on cash. So say, for example, you go to the bank and you want the money quick. The bank can't make any long-term plans with your money. They can't invest with it. And because they can't invest with it in anything long-term, they're not going to give you good returns on it. All right. So that's short-term and accessible money, just like your savings account. So as we talk, you can try and picture it, put yourself in the position, try to figure out which one of these you participate in. And number 5 is fixed interest. So the best known type of fixed interest investments are bonds, which are essentially when governments or companies borrow money from investors and pay them a rate of interest in return. So as I said, these are the different type of investment, and every one of you would have one of these products, whether it's cash, something that's growing, whether it's something defensive, or something that gives you periodic interest rates like a fixed interest investment. So we're going to look at the investment life cycle, and there are 3 stages. And this is another slide again that you can put yourself in the picture. And it's much easier because it gives you the age range. How old are you? I'm not going to tell you how old I am. So, because you see how I look young, fresh, and green. So, but you can look on this and see where you fall. So the accumulation stage, age 20 to 35. I mean, age 20 to 35 is such an exciting period in your life, because at this point, the individuals at this stage can build aggressive portfolios. The goal is to build emergency savings, which is short term, like what we talk about in your cash account. And we're looking at accumulating wealth, which is why we're here today, to learn about wealth. And that is for the long term. And these are through high yield instruments. So when you are younger, between the age of 20 and 35, you should be at the accumulation stage. And you see this, in the first line, it says aggressive. When you are younger and youth is in your favor, you find that you can be more aggressive in the way you invest. And a funny part of it, which you're not going to see on this slide, but is the reason why we're here, is because you're thinking about entrepreneurship. And entrepreneurship is one of the most aggressive form of investments. It takes a lot of guts. Most people don't have their own business because they don't have the wherewithal. They don't have what it takes. So I must commend you. The fact that you are here shows that you're taking a step in the right direction. And so an aggressive personality is suitable for an individual between the ages of 20 and 35. All right, we're going to talk more about an aggressive investor later on. And that you're going to, when you hear that, make your ears open up wide so you can hear about the aggressive investor. Now, when you get to age 35 to 40, that is called the preparation stage. And that is the second stage of the investor life cycle. So at this stage, your portfolio becomes more balanced as retirement is approaching. When you get to this age, you start thinking, but as a matter of fact, even if you don't think about it, the gray hair start popping up in your head, little by little, the gray hairs, and you start feeling the joint pains. When you start seeing that and feeling that, you know what time it is. It is time to prepare. So at this stage, you find if you have children, they're getting bigger, they're taking less, you're not buying Pampers and feeding no more, unless you're a hot girl or a hot boy where it's still in the business. But you know, at this point, you start concerning yourself about achieving your goals and you start preparing for retirement. And so you don't want to go all out aggressive anymore. You want to pull back a little bit and create a balance. And a little a bit this and a little of that. That is what you have balance in. So you're not 100% conservative, but you're not 100% aggressive either. You strike a balance between the two. I hope you understand what I'm talking about. So it's like, you know, if you are a drinker, for example, let's talk about alcohol here. And I'm not encouraging you to go and drink alcohol, but if you are a hardcore drinker, you drink your scotch on the rocks, there's no dilution. That's aggressive drinking. But as you get older, if you want to balance your alcohol, you tip some of the scotch and you tip some Pepsi and you balance it out. You put a little aggressive and a little modest and you balance it out. And the next stage we're going to talk about is the retirement stage. This is a stage where you put down the scotch maybe and you take up the Pepsi alone by itself, or you just tip little tubs of scotch to chase it. But the retirement stage is the last stage, the final stage of the investor life cycle. And in the last stage, what you're doing is trying to get income from your investment. At this stage, this individual may have stopped earning active income, right? You might be home and no longer going out there and getting a salary. You'll be earning from your passive income, and will totally depend on your savings as well as the returns on your investments to survive. So at retirement age, is slowing down a bit. You want to start enjoying the fruits of your labor. And that is why if a 65-year-old person comes in and said to me, I want to make enough money, I want to make enough money, right away, you're talking about aggressive investment. But here it is, we're asking somebody at stage 3 in the life cycle of investment is asking me to give them a stage 1 portfolio. And as a financial advisor, I am not supposed to do that. I am supposed to be conscious of the different variables and advise you accordingly. So I'm going to say, Miss Jane, I do understand that time running out on you and you feel like you need to make more money, but you can't afford to lose what you have. You cannot afford to lose what you have. And so we need to protect what you have in the final stage of the investor life cycle than put you into something that a 20-year-old or 25-year-old should be investing in. And same way, when a 25-year-old come and say, I don't want to lose my money, I said, you're talking the wrong language. Not losing your money means you don't want to take any risk. All right. So as it is right now, identify with one of these stage and prep your mind to adapt to it. Whether you're young, be aggressive. If you're middle age, then you become more balanced, a little of this and a little of that. And if you're at retirement, I want you to think about preserving your wealth, preserving what you've already worked for and earned. So know your risk profile. Are you conservative, moderate, or are you an aggressive investor? Your risk profile is intended to give you peace of mind, to ensure that the product selection suits your personality and your goals. So if you come to me and you're somebody with fraidy, and you say you want to make enough money, but you're fraidy, and I go and put you on the stock exchange and we buy some Grace Kennedy stocks for you, and you go and you watch the 8 o'clock news and you sip on the news, say Grace Kennedy lose today on the stock exchange, you can't sleep tonight. It means your personality can't manage that kind of aggressive investment, because what the news is giving you is just an idea as to what is happening. The news is not telling you that you can't, you can't make money from it because it went down. And we're going to talk about that later on, how you mitigate against losses on the stock market. All right. So the risk profile is directly linked to the expected returns. And so it is important to evaluate and decide on what works best for you. There is a term that says high risk, high return, medium risk, medium return, low risk, low return. So if you walk into an investment bank and you say to your rep, boy, me don't want to lose no money, automatically you've told them you don't want to take any risk. And low risk means low return. Then you say to the person, but we want to make enough money, but high returns mean high risk. So there is a disparity right there. So we have to come to an agreement. What you want to be conservative, or you want to be aggressive, or do you want us to just balance it out for you and be moderate? And so you're looking at a conservative investor, as we talk about at the final stage of the investor life cycle. As a conservative investor is someone who wants to protect the principal and is seeking just appreciation on it. This investor is comfortable accepting lower returns for a higher degree of liquidity because they want to have easy access to their money and they want to make sure that their money is stable, right? A conservative investor primarily seeks to minimize risk and the loss of principal. The principal is the amount that they have. All right. A moderate investor, you see, I put a middle-aged gentleman right there. A moderate investor values reducing risk and enhancing returns equally. This investor is willing to accept modest risk and seek higher long-term returns. All of these are keywords. So risk comes with a longer period of time. I will talk about that more. But the aggressive investor, that is the young man we spoke about earlier on, between 20 and 35, or the young woman. An aggressive investor values maximizing returns and is willing to accept substantial risk. This investor believes maximizing long-term returns, because they're young, they have a longer time to wait on the return, is more important than protecting the principal. Because when you protect the principal, it means that you're not going out there, you're not taking any risk, and so low risk, low return. All right. An aggressive investor may endure extensive volatility. They're not looking for the stability that the conservative person is looking for. They can endure extensive volatility and significant losses because they have more time to recover and to wait on their investment to turn back around. And so liquidity is not really what they want. They don't want to run in and take out the money. They want to put the money to work aggressively to give them returns. And so it is important to know what type of investor it is that you are. It is important to know the message that you're giving the investment advisor. When you step to an investment advisor, you sit down and you say, me no want no risk. Understand what you're telling them. You are saying it in layman terms, but they're interpreting your language and creating a portfolio for you. And so you need to assess your risk profile and have your advisor help you to design a portfolio for you that will meet your investment goals and also meet your personality. A doctor cares about your health, but a financial expert cares about your wealth. So why leave your finances to chance? You need to take a hold of it, understand it, and work with it. And if you're going to go out there as an entrepreneur working hard, 24 hours sometimes, you have to be brave. You have to talk to people you never see before in your life with a big smile on your face. Hi, I'm Leah Reid. I make bracelets. Please look at them. They're gorgeous. They would look lovely on your wrist. You know, when you're done do all of that and bolster yourself and go out there and you make your money, you want to make sure that you're investing it in the right and proper way. And you do that by understanding what it is that investment is all about. I hope I'm making myself clear. So I know a lot of you always ask the question, so what are stocks? And when people try to explain it to you, you still come back and say, what are stocks? Because a lot of times you're intimidated. You think that this knowledge is bigger than you, but it is not. Learning about stocks is as simple as ABC. And I'm not saying that because I'm talking from an investment advisor's perspective. I'm saying it because I know that everybody, every Jamaican, there's a new slogan with the Ministry of Education that says every child can learn, every child must learn. So all of you in here can learn and you must learn. So stocks are a type of security that gives stockholders a share of ownership in a company. Stocks also are called equities. And as you see the link, you see off of the internet, me get it. right? So I'm going to break it down for you a little bit more. My other thing here says, as the stock market fluctuates, which increases the possibility of loss, investors are encouraged to invest in the stock markets for medium to long term, as it helps to get past the volatility. Now, as you look at the image right there, so you notice that them up and them down, up and down, up and down like a roller coaster. But at the end of the day, none of the ups not touching zero line again. So see the zero line here. So although it is up and down all over the place, it does not come back down to zero. And a lot of times your investment in the stock market, it can come back down to zero and even less. But usually once it's a good company, good solid management, even with the up and down, if you take a straight line like a ruler and line it up from there to up here, you realize it is going in an upward movement. And so let us break down what a stock is. All right, so we're going to try and understand a stock. So don't think of anything else. Don't think about the definition we just talked about. Let us just think about layman term. Say, for example, you would have a bicycle from you did little bit, and you used to drop off at whole heap. Sometimes the chain drop off, and you were just a hands-on kind of person. And sometimes you just take the wrench and the pliers and you just pull down the whole bicycle and put it back together. So we're talking about bicycle now. Don't think about nothing else. Just think about bicycle. So you are there as a person who loves bicycles so much, and because it's your grandfather, they give you the bicycle, and in dead and gone, and you love it so much because it represents your grandfather and everything. Little by little, you start realize that your love for bicycle make you so good at repairing it. And one day you're home and you say, you know what? I want to start a bicycle repair business. But to start the bicycle repair business, you're going to need some tools, and you're going to need some parts. And all of this is going to cost you a good little penny. But you only find that you have $25,000 in your name. When you dig out all of your saving pan, empty out your bank account, the only money you have is $25,000. But the bill to get all of everything is $100,000. So you go to your mother and you say, Mommy, you can lend me some money. I need $75,000. You can lend me some money so that I can start this business. And your mother said, boy, listen, I know that you are very good at what you're doing. So I'm not going to lend you the money. I want a piece of the business. I'm going to give it to you to put into the business. And I now become a part owner in the business with you. I said, all right, but she only have $25,000 too. So now you have $50,000. 2 hours of money put together make $50,000. So what you do, you go to your father and you say, Daddy, I'm doing this bicycle thing. Mommy come in as a partner with me, you know. Mommy, a partner with me in the business. You want partner too? And Daddy said, so how much money Mommy give you? And you say, it's $25,000 Mommy give me. And you say, well, if your mother give you $25,000, I am going to give you $25,000 too. So you say, all right, thanks, Daddy. So now you have $75,000 and you have 2 partners. Then now your big brother come home from work and you go to your big brother and you say, hey, big brother, guess what? Me need some more money to start the business. And you know, say, Mommy, you're going to be my partner. Daddy, you're going to be my partner. And more want to know if you want to be in. And him say, how much money you want from him? I said, $25,000, because me know say the $25,000 are going to make $100,000 and you can pay off the bills with that. So you end up with $100,000. So big brother give you $25,000. You end up with 3 partners, and the 4 hours of money come together, put together by all of the parts you need, all of the tools you need, and you come together and you have one bicycle making business and you're doing a very good job. Great. That is something practical that you can relate to. Now, put it in a business context. Is Mommy a partner? Daddy a partner? Your brother a partner? And you a partner? Yes, you are. But guess what? They're what you call stockholders or shareholders, because they share a part of the business. And that is why you get the word shareholders, because they own a piece, a share of it. And why it's called stock? because each person in that scenario has an equal part, and it's 4 people. The business can cut up in a 4-part. If it was a cake, you'd have cut it in a 4 equal part, and everybody get 1 piece. And when you put it back together, you get 1 whole cake. And so each slice of that cake is called a unit, and the unit is also known as a stock. So the bicycle business has 4 stocks. Each stock is valued at, puts in the chat, let me see if you have learned. Each stock is valued at what? In the bicycle business, each stock is valued how much? So there are 4 stocks because 4 people invest and everybody have 1. I see the answers coming in. Each stock is valued at $25,000. No, the bicycle business take off like a BG kite, and the bicycle business is going on. It's going on. It's doing so good. And so guess what? The money growing, and the money reach 200,000. When you make it up and you check up how much stock you have and everything, the value of the business is now at $200,000. How many shareholders do you have at this point? Tell me again, how many shareholders you still have? When the money reach 200,000, how many shareholders you still have? That is right. You still have 4 shareholders. So if you have 4 shareholders and you have 200,000, how much the shareholders now have? You're going to divide the same 200,000 by 4. And you're going to end up with 50,000. Each stock is now valued at $50,000. Now, if your brother get to go through, him file for himself at Canada and he want to go away, and he don't want to be in the business anymore because he's going to need all the money he have. He want the 50,000 to buy him plane ticket, to put towards him plane ticket to go to Canada. You now have the option to buy out your brother's share. So all you need to do now is get some money, $50,000, give to your brother, him take for him $50,000 and gone. You end up with 2 shares or 2 stock, but you have 2 shares in the business. And mommy still have 1, daddy have 1. So you own 50% of the business. Now all of a sudden it's back to school time, and you find out, say, nobody now buy bicycle parts right now, them kind of ease off a little bit and take a little break. And then you find out that you buy up some stock and things might go down a little bit. So it can go down below the $200,000. So when it goes below $200,000, and mommy get nervous and say, boy, you know, say 50,000, my stock did work before, and now my stock gone down to 40,000. Boy, I'm afraid. No, you're gonna say, mommy, what are you afraid for? Don't you start with 25,000 and now you have 40? Don't you still in the positive? Don't you still earning money, mommy? What you get afraid for? Don't you believe in me? Am I not still your good son that did bring the business from 100,000 to 200,000? Now that it dropped down a little bit. Have confidence now, mommy. And mommy bolster up and have that confidence in you again. And boom, boom. Everybody pay off school fee already and everybody settle back down. And October come a holiday come around and everybody want to ride and go on trip and they want to fix up at them bicycle now, and book the business gone all the way, skyrocket 300,000, 400,000, and half of that is yours and the rest are half of the other 2 shareholders because you hold 2 shares. Now you see what I say when I tell you that it's easy to understand? All you have to do is remove the bicycle and put a company like Grace Kennedy in the position. Grace Kennedy don't have 4 shares. It has a whole heap more. But it's the same way you can buy a piece of it. It's the same way you can be a shareholder in it. And when you buy into it, nobody not owe you nothing, forget about nothing, because you are going to take the risk of the business just like the rest of shareholders. And if the benefit is there, you're going to benefit like that. And a beauty about it is the stock market in Jamaica is tax-free. So although it is risky, because like mommy, the money can go down to 40,000, but that is why we talk about waiting it out. So now you see when we talk here, so that says that you can invest from medium to long term. Mommy going hold on with her little 40,000 and she going wait, and then your sister it start go back to 50, on to 60 and growing, because she could wait it out from the medium to the long term. And she get past the volatility part of it, because it's the first part of it kind of tricky, and you have to buy back some, and things that not work out good yet, but you get past that and move to a different stage of your investment. So what are stocks? Stocks are those little beanie piece of a company that you can buy to become a part owner in an existing business. It is the same thing they call equity. So if you see somebody and say, oh, do you want to invest in an equity account? You will be of the same understanding that they are indeed talking about stocks, which means that they're talking about buying a little piece of an existing company, being a shareholder, and being a part. Can you imagine you cannot buy the whole Grace Kennedy or the whole of NCB or Barita? You can't buy the whole of Supreme Venture, but you can buy a little piece, and every month or every 3 months, you can buy a little piece more and increase your share ownership into it. I want to see in the chat if you're understanding so far. Let me see if I'm getting any message. Is it clear so far? Should I move on? Do I have a bright class today? I don't see nobody answer. Anybody understand stocks better now? All right, good. I see a few persons answering. Let's move on because you're bright, so we can take it to the next level and talk about some more things. Look at this page. It looks like a bear page, but guess what? We're going to click on this right here. This is the website for the Jamaica Stock Exchange. And I want to show you how you can click on the Jamaica Stock Exchange and understand it for yourself. So Jamaica Central Securities Depository is an arm of the Jamaica Stock Exchange that deals with the stock part of it. And so when you click on this, if you just go to Google and type in Jamaica Stock Exchange, it's going to carry the same place that we're going to go now. And if you click on, if you type in www.jamstock.com, jamstockxex.com, you go to the same place. Let's look at it. I hope you can see. Can you see me? All right. I hope you can. So now we just clicked and went on the website of the Jamaica Stock Exchange. And on the Jamaica Stock Exchange website, you see the sticker going across showing you what is trading on the market right now. It's telling you how much volume is being traded and the price. So this here is called a ticker. You see Fantana, it's telling you about Fantana. I don't know if you can see it from there. It tells you about TransJam. It's TransJam TGJH. I don't even remember. Jam T, Jamaica T. All right. So it asks you here, are you new to the Jamaica Stock Exchange? And it says everything you need to know is right here. So here you are, not even realize that you can get all the information on the Jamaica Stock Exchange's website, but you really can. And so you can click get started, and it starts telling you about what is a stock exchange. So it's telling you what the stock exchange do. And in layman term, stock exchange is like Coronation Market. It is a marketplace that you exchange goods for money. So when you walk to Curry and you have money and you can buy tomato, you go to the stock exchange, same way with your money, and buy pieces of company. It's just that Coronation Market is a physical space and the Jamaica Stock Exchange is not physical. It is intangible. You can't touch it, but it exists though. And it traders, you find buyers and sellers meet and you exchange on the stock exchange. And it tells you what are some of the basic functions of the stock exchange. What is a share? Remember, we just talked about share a while ago. Let us see if you can understand it from here. A share is a unit. You remember we talked about the unit of ownership, interest in a company. When you buy or receive shares in a company, you become a part owner of that company. This is known as having equity in that company. Equity is another word for ownership. The more shares you have in relation to the total number of shares issued by the company, the more of the company you own. For example, if a company issued 10,000 shares and you own 100 of that share, then you are 1% owner. And if you buy more than 100, you increase your ownership. People who own shares in a company are referred to collectively as shareholders or stockholders. So if you forget, you can go on the Jamaica Stock Exchange website, jamstockex.com, and you can see this information. Are there different types of shares? Yes, there are. You have ordinary shares, you have preference shares, but the ones we talk about, the ones that comes on the news every night during the week is called ordinary shares. So those are the ones that we talk about mostly. Preference shares is a little bit more complicated and it's not offered as readily. How are shares traded? What are the benefits of owning shares? Why do companies issue shares? Well, one of the benefits is that you may not be able to own a bank, but you can own a piece of the bank. And when the bank come on the news and say, we make how many $1 billion for the year, a part of that is going to improve your ownership in the bank. And you're going to get dividend as well. And it works out for you, so you get more money, all right? Why do companies issue shares? Because they want to raise funds. You want to pick up capital. Remember the case when you have the bicycle shop? Why did that bicycle shop man went to his mother for money and give her a share? It's because he wanted to raise money, right? And because he wanted to raise money, he sold pieces of the business. So that is what companies do. So instead of taking a loan from a bank or instead of taking out all of your savings, what you can do is go to the public, like the bicycle shop man, and get money from there. What is a dividend? Dividend is something that you don't have to get, but when a company makes very, very good profits and they put back in the business and now everybody is happy, whatever is left over, they can decide to put some of that back into the hand of shareholders. And when you look, you see a check come to you in the mail. And I said, Jesus, please, me get money. You know, it's just like easy money. It's not really easy money, but it's money coming from the progress, the success of the business. What are some of the things I should know before I buy a share? You can go back here and read it. What are the risks involved? Yes, there are risks involved because we talk about up and down. Where can I buy shares? How do I buy and sell? It tells you all of that. There's a lot of information there. And it also tells you about online trading. It says we invite you to utilize the online trading platform, which is JTrader Pro, to buy and sell securities at your ease and convenience. So you can buy shares through a broker. Yes, you have to have a broker, but you can, after you have the broker, you can actually trade your stocks on your own by going to JTrader Pro. Right? And you can click right here, online trading, and go there, but I'm not going to go there. I'm going to go back and I'm going to show you. So these are all the companies associated with the Jamaica Stock Exchange. I want you to be able to go on this page and don't feel intimidated. I want you to go on it and start click, click, click like a boss. All right. It tells you a little bit about the stock exchange. Right now, there's an IPO out, the Jamaica Fiberglass Company. You can click on this IPO, learn about it, buy it. It's going through NCB. NCB do it online through their IPO platform, and you can enter from there. But you first have to go through a broker, get a JCSD number, and use that JCSD number to purchase your shares. And so you can come on Jamaica Stock Exchange website to learn about stocks, right? And you have even here e-invest, which is an arm. You can, well, I said here, you can go e-invest and never miss an IPO. This is what I really want to show you. You can click on this list here and see all the companies that are listed. Remember, before we talk about preference share and ordinary share, you can see it in this lineup here, tell you the type, but it's really the ordinary shares that you want to look at. Because we've been talking about Grace Kennedy all this time, I call up the people in name, Let us look for Grace Kennedy on this list. So you want to know if a company is listed, you can find it there. So here you are, Grace Kennedy Limited. The symbol is GK. It's in Jamaican dollar. It's a conglomerate and it have ordinary shares. Let us click on Grace Kennedy and see what we see here. So you click on Grace Kennedy, it's loading, it's loading, it's loading. Here we are. So on the news, when you see Grace Kennedy, they go down. See, it's showing you right here that it went down by 0.53%. And one share is $102.03. So Grace Kennedy more expensive than the bicycle shares. And it shows you how much it started at this morning. It shows you how much it opened with, how much it closed at yesterday, how much it opened with. And you see when it's a bid, which is a lower price, it means that all the people who want to buy the stocks want to buy it at a lower price. And ask is a higher price. Everybody who have it and want to sell it wants to sell it at a higher price. But remember, so just like her nation market, if you pick up the tomato and them say a $50 and you say a $40 you have, if the price is different, you cannot trade. So it has to match. So the 102 have to be offered and somebody have to accept the 102, or somebody asks for 102.45 and somebody accept it. You have to agree on this price in order to trade. And you'll see the volume traded, 52,998 shares were traded at an agreed price. All right. This here show you, I don't know if you can see the map, but if you click in later on, go to the Jamaica Stock Exchange, you can see the map. You can click and look at 1 year worth of the up and down, and it shows you how the price has been moving. And I love this side. No, I'm not even a maths brain, you know, I don't really love maths that much. And when I can tell you that I love looking at certain numbers, you must know. So right here, the trick about this is it says 52-week range. And when you're buying stocks, you want to know 52-week range. 52 weeks is 1 year. And it says over the last year, the highest Grace Kennedy was sold at was $105 and the lowest was $76. So if you look at $102 now today, it last traded at $102.05. It is closer to the top than to the bottom. So suppose the stock come down, suppose you see Grace Kennedy come all the way down and start selling for $90. Or $8, that would be a good buy, because you know, say it not at the lowest, but it all the way down. But you know, say people willing to buy it at $105. So you know that the spread between how much you buy it for and how much you sell it for, that is the profit that you make. So if you buy the stock for 10, like how the mother buy the bicycle stock for $25,000 and she sell it, oh yes, $25,000 now. It's more expensive than Grace, and she sell it. If the brother sold his at $50,000 right there, so it make all of $25,000. It's the difference between the buy and the sell price is your profit, is your little piece. It's called capital gain. So you gain, you don't get interest on stocks. Interest is for bonds. On stock, it is the difference between the buy and sell price. It's like you're a higgling, buy and sell. So down here, it gives you some more details. And when we talk about dividends, if you want to buy a stock that gives dividends, this is one of them. So it tells you when and when they gave dividend. And right now you can see that a 4th time last year, Grace Kennedy paid dividend. One time they give you 55 cents for every share you have. And one next time 48 cents. And 45, and that is multiplied by the amount of units you have, and that tells you how much you get. All right, so just to give you a little briefing on how you can go to the stock exchange and make some money. Now, based on how my screen stay, it's going to give me a little trick to go back, so bear with me. Let me get back here with my screen. Hold on. All right, I have to click back on my presentation, then I get back maximize. Then I go back here. Great. Can you see my screen? I hope you can. So we're back to our presentation. So we just went take a dive, we divert and went to the stock exchange. It's like a sightseeing. We went and visit the stock exchange and we're back now. So what is inflation? It says rising inflation can affect your hard-earned savings. No, I deliberately did not give you any textbook or internet explanation of inflation, and I didn't give you any bright person explanation. I'm going to give you my explanation of how I understand inflation to be. Now, inflation means, say, if last year I could buy 10 mango with $100, this year I go back to the same vendor with $100 to buy 10 mango. They said you cannot get 10 mangoes, Analia. You can only get 8 mango. Me I said, then how comes at the same $100 me have? And at the same tree, the mango them come off. So why would the $100 can't buy it anymore? How much for 10 mango? Them say $120. So me say $120 for the mango. And it look the same way, it not grow no bigger. How comes at $120? That is because of inflation. Inflation make my money weaker. So what I could get for $100 last year, I cannot get it for $100 this year. So the bigger the inflation percentage, when government tell you that inflation is 7 point something, 8 point something, 10%, a lot of times when you do the calculation, it's roughly about 10%. So if for the year, your money decreased by 10%, it means that anything you buy last year for $100,000, you can't get for $100,000 this year. Your money coming like $90,000 to that thing again. You need more money, you need $110,000 to get what you could buy. What does that mean for your investment? It means that if inflation is 10% and you are getting 2% on your interest, every year you're 8% poorer. You get that? Let us say it again. If last year you put down $100,000 and this year your $100,000 grow by 2% in a bank account, but the Jamaican inflation rate was 10%, it means that your money weaker than last year. It is 10% weaker, but the 2% you got on it give you 2% stronger, but you still have a deficit of 8%. So you need to get an interest rate equal or above inflation to keep your purchasing power equal. So therefore, if you were getting interest on your money and you carry the $100 to buy the mango and you give me for all, I may put back the 10% on it, and you go your ear say 20% on it, and you go your ear say $120 for the 10 mango. And when me give you back your money, me give you change on it because me the owe it and I use it. So me put $20 on it. When you look, your $100 would have turned $120, and so it was easy for you to buy the mango same way because the extra you got brought up the purchasing power of your money, so you can get the same. So 10% would keep you at the same level as you were last year. Although the money look more, but the ability to buy things is less. So inflation weakens your money. So rising inflation does affect your hard-earned money because the greater the inflation, the weaker your money become. You need more money to buy the same thing that you could buy with your money last year. And so what are bonds? Am I going too fast? I hope I'm making it. I hope you're writing notes and I hope it's becoming practical enough that you can relate to it. Because and it's a lot of material in one sitting. It's like you're eating whole heap of different food one time and you know, say it can bind you up and give you colic, right?
Analia.
Yes.
You have a comment in the chat here from Shanae Montague. She's asking you to dumb it down a little bit more, please. I guess that's the part with the last slide that you were just on.
On the inflation?
Yes, the inflation slide. So
you want me to
just explain again what inflation is, that even if you earn more this year,
yes,
if inflation continues to rise, the value of the money remains the same. So if it's $100 last year, and you get $150 this year, I still $100. It's unfortunate, but yeah, that's what it is, really.
Yes. Right. What you do, Shanae, write down the word inflation and right beside it, search YouTube. You're going to search YouTube for inflation and listen to the different persons explain it to you. Inflation is an economic activity that basically the rise in inflation means the economy is being impacted by a rise. It's being inflated then, which means that you actually need more money to buy things. More money is needed because your money does not remain the same if inflation is moving. So if you have $100,000 and inflation moved by 5%, it means that your money, your $100,000 is 5% weaker than it was last year. All right, Shani. Now, because the presentation is so dense, I won't be able to spend too much time on one slide because there are a lot of slides. So write it down, and I'm happy that you asked. It means that I've piqued your interest with it. Because all you want to hear is that your money get weaker and that your $100 can't buy 10 mango again. And that in and of itself is a concern, Shani. So learn about inflation. How are you going to combat the inflation? By ensuring that your 100,000 is rising above it. Now, how you ensure? By finding an investment advisor and beat them down to tell you, how do I make more money than inflation? So when I'm earning 2% on my investment account and inflation is 8%, how do I bridge that 6% gap to keep my money where it is, the purchasing power where it is, and to even increase it above that? You have to get investment options that are beating out inflation. That is the purpose of this slide, to let you know that if you put on $1 million a year ago, and you plan for that $1 million to last you when you retire, it is going to be too weak. When you retire, the $1 million can't do much, right? So learn about inflation. Go on YouTube, go on the different, type it in Google and search for inflation, okay? Thank you very much, Shani. I'm happy that you're listening and catching on, and I'm piquing your interest. So let's talk about bonds. So, what a bond is, it is a type of security similar to an IOU. So say, for example, your mother come to you and say, Shani, lend me $100,000 and I'm going to give you back 10%. But how am I going to give you 10%? Every month I'm going to give you back what is accrued on it. So let me use that easy figure. So you lend your mother $100,000. She said every month she's going to give you $5,000. So you know the $5,000 is the interest. Now, it is that contract that you and your mother have that has the name bond, or it can be a treasury bill or a LRS, or it can be a money market instrument, whatever it is. But it is the contract that has the name. It's a contract that carries the name. And so what are bonds? Bond is when, bond mean you owe somebody, it's a debt instrument. So when your mother have that bond with you for $100,000, it means your mother owe you $100,000, right? And she's going to give you interest incrementally. But what makes bond unique, different from stocks? When somebody owe you, it is different from when you have equity. Equity means ownership. When you owe, it means debt. When somebody owe you, it means them have to pay you back. Now, you know that your mother borrowed $100,000 today. You know that you're going to give you back 1 year time. You know the interest rate. You know your mother good for it because she's a good woman and she live up to her obligations. So you're not taking much of a risk, are you? So that is why bonds are safer, because you're not taking much risk. You know everything. You know when it starts, you know when it's done, you know how much interest you're going to get. You basically know everything about it. And because those terms are fixed, That is why they call it a fixed income investment, because everything about it is fixed. It's like when you have a CD and them tell you how much you're putting in, them tell you it mature in 3 months time, them tell you you're going to get 2% on it. You know everything about it. So your risk factor is low, and that is why you earn lower on it. And if you notice, it is always going in an upward position. Why can it dip? It can dip if you want to exchange the bond before the maturity. So suppose your mother is going to give you back next year, but halfway through the year, you want back the money, but you can't go to your mother because she already tell you when she's going to give it back. You can go to your brother and say to your brother, say, look here, mommy lend me some money, right? And because of that, I want back my money, but mommy will give it back to you 6 months time. And them say, what's in it for me? Them say, mommy, go and give you $5,000 every month. And them say, yeah, but me not gonna give you all of the 100,000. I give you 90,000 and collect the 5,000 from mommy same way. And you say, okay, that's when it dip, because instead of getting the 100, the principal that you're getting back is actually lower because you're trying to terminate before the maturity date. And that is how bond prices move. But the principle, the basic principle of bond is that, or a fixed income is that you can live it out from beginning to end. But sometimes you hear that government give like a 40-year bond or a 50-year bond. You may not live out that 50 years, right? So you might want to sell it at some interval or pass it on to your family as inheritance later on. So bonds are fixed. It's not as exciting as stocks because everything you know about it already, you know everything about it. But it is good to learn about bonds and also to learn about how do you measure the safety of a bond. All right. And remember, if you're curious, you can go and Google it and learn more, or call us at Barita and we can help to guide you along the way. So unit trust investment is another form of investment. And a lot of people always wonder, what are unit trust investments? You see here, I show you these to show you that it is not just one investment like a bond, a government bond, or you buy a Grace Kennedy stock. For unit trust, it's when you take multiple things and pool it together, right? And you can pool it according to the risk profile. So an article came out in the Observer last year written by Daniel Brown, and it says a unit trust is a collective investment scheme. Investors pool their money and then use that fund to invest in different assets, such as stocks, debentures, or real estate. You may have also heard of a mutual fund, another collective investment scheme that operates in a similar way. However, a unit trust is established under a trust deed. Now, what a trust deed is, I don't know if when we went to the stock exchange, you saw that part where they said that there are trustees. You can have a trustee that overlooks a trust deed. And what it is to make sure that the customer's money, because here it says collective investment. It means that enough people, enough investors pool their money together. So let me give you an example. Suppose Kingston Wharf, and this is not real, this is totally made up. So suppose Kingston Wharf, the story is made up. Suppose Kingston Wharf say, you know what? We want a dry harbor, want dig out a part of Kingston Harbor, and we're going to make ships come there, and then going to be able to unload and undock and lift out and fix the bottom and all kind of things. We want that, but we want to use $20 billion to do it. Now, Barita has a fund, right? And it's help fix ship fund, for example. And we want that $20 billion to give to Kingston Wharf. So Kingston Wharf say, if you give me the $20 billion, we're going to give you 10% return. Now, if you, Shanae, have $10,000 and Sansia has $100,000, if you carry it to your fund manager and you invest it, you're only going to get 2% or 0.5% or 1%. But here it is that Kingston Wharf is willing to give 10%. How do I get a part of that 10%? What you do is Shanae 10,000, Sansia 100,000, my 50,000, the person the million, the person the 3 million, all of it. You have a fund manager who collect whole heap of people money. build it up together. And then when they come up with the 10 billion, they can take it now and invest in Kingston Wharves. And they get the 10%. And Barita say, all right, I get 10%. We have to take out management fee. We have to pay the light bill. And Leah have to get paid to go home and take care of our children. So we're going to take out 4% and give you 6%. So here it is, Shanae getting 6% for 10,000. Sansa getting 6% for 100,000. Analia getting 6% for 50,000. Tankita getting 6% for 10 million. And everybody, the big and the small investor, has an opportunity to earn 6% where they would not have been able to earn it on your own. And that is why you're going to a unit trust where you have a fund manager that gives you an opportunity to participate in massive investment opportunities. And not only one, but several, by pooling people money. Some people might hear about crowdfunding. It's a pool type of thing, but it's from a different perspective. You might hear about people coming together to buy something together and so forth, partnership or so forth. So unit trust is regulated and it is governed under a trust deed. And unit trust means that whole heap of people put the money together, but in order for you to know how much of it is yours, they split up the fund into tiny units, assign a price to each unit. And so when you carry 10,000, I'm saying, oh, for $10,000, you are able to get 20,000 units. For $100,000, you're able to get 200,000 units. And so you buy the units. So it's talking about buying units, but what you're doing is investing in a pooled investment that is going to be used to invest in a larger form of investment, to give a small investor an opportunity as a large investor would have had. How does that benefit you? It gives you more bang for your buck. You get to earn like a big shot. You get to earn like how big money earn. And not only that, it creates diversification for you. It allows you to diversify your investment. So there I spoke about 3 critical forms of investment products. We talk about stock, which is at the end where we spoke earlier on when we talk about growth investment and shares. We spoke about those. When we talk about fixed interest, we talk about that at number 5. And when you take a defensive position, you can invest in unit trust and have a defensive position. So here it is, you know everything on this page just like that. You know how to grow your money by investing in stocks where your money can double, triple, quadruple in no time because of the increase in business activity. But we know, say, it is aggressive. We learn about the bonds, which is at number 5, where you get incremental money that you can live off. So you retire and you want to get interest every month and you want that money to come in to pay a light bill. You look at bonds or fixed income type of investment. And we talk about defensive, where you get a mix, where you get to put some risky and some income and put it together and you have a defensive position. And we talk about cash already because cash is what you get in your savings account. When your pay goes there, it goes into a cash account. All right, we talk about the stages. So we look at 20 to 35. If you're 20 to 35, if you do not have a stock account, I wanted to call Shanique Williams, start sending her an email. You have to have a stock account if you're under the age of 35. There's no 2 ways about it. Because if that is not happening, you are missing out on an opportunity to aggressively build your portfolio. When you get to 35 and 60, when you should be slowing down, you can't be coming in to get aggressive at that time. But if you're not there yet, please speak to your financial advisor about it because you need to get a mix, right? But you have to have stock portfolios and you have to create a mix. Little of this, little of that, every mickle make a muckle. You know, diversification, you can't put all of your eggs in one basket. Right? We want you to retire strong. We want you to know where you are and assess your risk profile and design your investment accordingly. And so as we go to our financial advisor and we talk about these products, we don't want to do it as lip service. I don't want you to leave here today as just another person talking off your ears and you don't learn anything. I want you to get serious. You won't learn everything in this presentation, but I want it to pique your interest so that you can move forward. right? And this is a little tip about how you invest. Half of what you earn should go to your needs. So you need to pay your light bill, you need to eat food, you need to get water, and especially with online learning, you might need internet. Those are your needs. Write them down, know what your needs are. 30% goes towards your wants. What are your wants? You might want one furniture down a courts. You know, you might want a bed, but you can't do without it. You might want to go and do a course, but you can do without it. So it's your want. So you use 30% of your salary. So 50, 30, and 20 make up 100%. What do you do with the other 20%? Make sure you're investing and saving that extra 20%. It's hard because at the rate of things, sometimes now your needs might take up the whole of your pay and more. So it means that any little extra cash you have, put it down into saving, and don't stop saving until you get to the point where 20% of what you earn is going definitely into some savings and investment. And then anything over that now, you can still be putting it into your savings, but it is a start. Your aim, work out your pay. If you get $100,000, 50,000 for pay off all of your bills and take care of food. And we know that food is very expensive and it's going to take a whole heap of running up and down. You might have to make sure you shop downtown and all these things, right? You might have to change from certain kind of, you might like salmon, you might have to change and buy fish instead, or change down to tin mackerel based on your preference and your taste, right? But it is most important to allocate $20,000 out of that 100,000 to save. And I know it is very hard. So if you have 2,000, save the 2,000, but don't stop. Don't stop pushing and trying till you get to the point where 20% of your savings, you might not do it today, you might not do it tomorrow, but push hard nonetheless. Cut back on your right now. I mean, even my light bill, I reach a point where you have to turn off the heater. You can't use AC. You try and make everybody come into the living room and use one fan. And only when you go to your bed, you can use different fan, just to cut back on your light bill so you can maintain and progress by having your investments. All right. So why do you save or invest? Why you do it? Why you do it, Shanae? Why are you here today listening to this woman going on and on about it? So some of the reasons why you want to invest, Shanae and Sansia and all the other persons on the line, you want to have an emergency funding. And people will give you guidance and tell you 6 months worth of your pay is supposed to be emergency funding. That means, say, anything will go on your rainy day, anything will drop, you catch it back with your emergency funding. You want to save for your retirement because when you get older, you want to retire strong. You don't want to hold no pan later on if you need medication and beg people for the embarrass you after your work so hard already. So you have to save for your retirement. And Sansa will have to invite me back to talk about retirement, because retirement in and of itself is an entire presentation. I couldn't even touch on it because I already take up so much time and we don't talk about that yet. You need to save for your down payment on your house. So even when you see the house that might advertise, Gore say you must come and write down. Once you write down your name on the Gore list, you know, you need to start save to make that deposit. And the deposit not cheap, right? You have to save for your deposit for your house because you don't want to retire in a rent house. And after you build your house, you want to put on one next little room at the back so you can rent it out later on if push come to shove, right? You want to save or invest to maximize your interest rates. Why I say maximize the interest rate? Sometimes you have one investment where say if you invest 100,000, you get 2%, but under 100%, you get 1,000, you get 1%. You can save to reach 100,000, so you get better interest rates. So you save until you get better interest rate. You save for vacation, car, and other big purchases. You save for irregular and recurring expenses. What is an irregular recurring expense? You might want to take out a better quartz and take it out on higher purchase. It is irregular because it not gonna last too long, but it may recur every month. You still have to pay quartz for a year or 2 years if you take it out on higher purchase. So you want to save for that. You save for your college education. You save for wealth creation, which is what we're talking about about today. You want to save for your children's education, because one thing my mother always said, my pitney must brighter than me. And I believe that my pitney must get more education than me, right? And you want to save to create an inheritance. The Bible says when you're dead, you must dead leave something for the next generation and generation after that. So you want to leave back something for your family, so that you leave your family better than they come and find them, right? And so these are some of the reasons. Are there any reason on there for you? Tell me in the chat. Did you see anything that apply to you? Is there anything on this list that encourages you to save? Just say me. Let me see the numbers so I know if I reach you. Let me know my audience. This is a roll call. Anything here apply to you? If it applies to you, then take this information to heart. You need to invest. And your little savings account, now cut it. You need to know more. So how do you start investing? First, you need to identify your goals. You need to have a time frame, and you need to feel out your risk. So earlier on, I tell you, you must know about your risk appetite. You do all of this. What are your financial goals? We talk about them here. Which one of these you're going to save towards, or which 4 you're save towards? Because I know you might have more than one of them on your list. So what you're going to do is identify your financial goal. Give yourself a time frame to achieve it. And you're going to decide how much risk you're going to take to get there. Remember, more risk, more return. Decide whether you want to take a do-it-yourself approach or manage it for yourself. Get somebody to manage it for you. So do it yourself. Remember, I show you on the stock exchange website where you can actually trade online for yourself. And sometimes you go in and you know everything already. You go up on YouTube and you know everything, and you come in and you tell us, I know I want already. Or you can get a fund manager to manage it for you. You need to pick the type of investment account that you want, or the combination. So when we were talking earlier on around here, where we talked about, hold on, when we looked at these, you can choose a combination of these. You can say, I want some shares, I want some unit trust, and I want some fixed income product, and I already have a bank account where my pay go. So you can have a combination and not just stick to one. So you can decide for yourself if you want to have a combination of things, right? But you can decide that, because once you start the account, it's going to ask you that. And once you have that in your mind, or you're working towards it, you go and you open the account. So the next step from here is open an investment account if you don't have one already. If you have one already, you need to understand the type of investments that are in there. So choose what investment match your risk tolerance, whether stock, bonds, or mutual funds. So let's talk about opening an account. I'm going to breeze through this because this is actually on our website. You can go on our website and find what is required to open an account. You need to have a government issue ID, which is driver's license, passport, or national ID. Even if the voter's ID, the expired one, you can use it the same way, because the government said we can still use those until they issue the new ones. You need to have TRN. If you're not a Jamaican, we still need a tax number for you. So your social security, NIS, if you're in UK or Canada, your SIN, social insurance number. If you live in Cayman or one of those islands that don't have a tax number, you will have to take your paperwork and go to the TRN office, apply for a TRN, because we cannot open an account without a TRN. And if you have any US affiliation, if you're born a foreign, or if you have your green card, you must provide your social security number. That is required by the IRS in America. Proof of address, you must tell us where you live, utility bill, bank card, credit card statement. You can get a letter from a JP. We have some forms if you need to carry a form to get proof of address. But the government said we need to know where you live, right? Verification of source of funds, pay slip, sale agreement, bank statement. You have to show us where the money coming from, because the law said that we're not supposed to take any scammer money, any illegal money. We can't take it. So you have to show us where the money coming from, that where you get money from. Once you're employed or you're in business, you have to show us. If you have your own hair salon or your farmer, there's a form that you can get to give a JP to sign to say that they verify that you actually do what you say you do, and they can witness that to that. You need 2 references. You can just give us a phone number and we'll call them and do the verification. And the list of people are also on the website. You can use a judge, a court judge, a lawyer, doctor, Indian chief, minister of religion, police officer, whole heap of people are there, principal of a registered school with the Ministry of Education. You have a lot, and you have to complete the application and sign it. So if you're not investing, you have to start now, and remember that you need money to start that investment. So you have to understand how the money part works. We don't take Jamaican dollar cash over 100,000. There are some institutions that don't take no cash at all. You have to get a check. You have to do a wire transfer. Understand that part of it. Some investment banks can't take US dollar cash either. So you work out that part before you take your money out of the account at the bank. Work it out, because sometimes people go take out cash out of the bank and we cannot accept so much cash, and then you feel frustrated. So talk about it first before you make that move. You can add to your account anytime you want. Add regularly and it works for you. Interest alone not gonna make you rich. You have to add to it. Do your part. And you can set up an automatic transfer from your bank to go into your account, and you can even do salary deduction by making your employers, if you're employed, send it straight to their account. So some takeaway points is that investing regularly pay off in the long term. Look at the trajectory rather than the daily up and downs. When you watch the news and you say, Grace Kenny, they went up today, it came down today. Don't worry about that. Look at where the company going overall. Do they have solid leaders? Do they have a solid platform and principle strategy that they're working on? Are they current? Once you never see nothing in the newspaper to indicate, usually they're doing good. Create an investment plan and stick to it. But you can revise it periodically. You should revise it periodically because things change in the market, but do that with your financial advisor. So if you open an account 5 years ago and you haven't spoken to your advisor, you are in the wrong. You need to go in and talk to somebody, and you don't have to pay to talk to an investment advisor, right? You need to set your goals, make them specific, measurable, achievable, relevant, and time-based. That way you know if you're achieving your goals. So that again, you can type into Google how to set goals. It's called SMART. Use SMART. Make SMART goals setting. Set your goals SMART. And you can go on Google, type in how to set SMART goals, and it will give you all of this. All right. And so in review, we've just talked about stocks, bonds, unit trust. We spoke about the investor life cycle. We talk about know your risk profile. We talk about why you invest and how to do it, how to get started, what you need to know. And we just encourage you to keep on investing. So my next part of the presentation is about entrepreneurship and tying it together, as I had said on my very first slide. We're going to tie it all together, right?
Before you jump into that other slide, that other side of the presentation, Leah, let's just do a little comeback, because
right.
I know I promised a very informative and interesting presentation. And let me tell you, while you were on screen doing your thing, Shanique has been in the chat doing her thing. I mean, it's like too complete. It's been so active in the chat. So much information being shared and so much knowledge being shared as well, because when you look at even Shanae asking the question about inflation, the reality is that when inflation is reported in the news, it's not something that is explained. And the average Jamaican probably does not understand it. The information shared from the Jamaica Stock Exchange website as well, you know, use of some of the keywords like the risks, assessing your own risk, looking at what you are able to do based on your own personality. You know, it's really, really informative. And I just want to thank you, Leah, for sharing with us this morning. There is a question for you in the chat, though, that I would like for you to address before you move on. And so I have a question from Ruth Stennett, and she's asking, how do you register a social enterprise And I think it's on the stock market that she wants to know, how is that done? How is that registration done?
All right, to register social enterprise is not something that we do every day. And so to do that, Ruth, I would encourage you to come into our office so we can sit down and go through it together. It's a process. We can call a stock exchange, figure it out together. But doing that is not an everyday activity. And so because of that, it will take some time to come in and work out. So it can be done because it is being encouraged. The stock exchange is diverse. I mean, I'm so impressed with the Jamaica Stock Exchange, knowing that they are a government entity, but they're so forward thinking. They are going out there and creating opportunities and trying to be at world class. And so I encourage you, Ruth, come in, let us sit down and talk it through. I don't have a step 1, step 2, step 3 to give you. The truth is that we've only spoken about it, but we haven't actually done it yet. Right? But you might be our first opportunity to sit down, pick up the phone, call the stock exchange, work through it little by little. At this point, I'm going to give Shanique an opportunity to just say something and share her thoughts before I jump into the other side of the presentation. So Shanique can be reached by email. She's S, as you'll look on the screen, you'll see s.williamson@barita.com, and you can reach her at 926-2681. And we also have a website, www.barita.com, and at our website you can get a lot of information. So Sansia, would you be able to allow Shanique to open her mic?
All right, so while we find Shanique to get her on screen and so on, I wanted to ask another question.
Please
The slides, Leah, will you provide the slides for us to share with the persons who are in the presentation this morning?
Most definitely.
All right, that would be great because it's a lot of information to absorb, but it's also interesting information, and I'm sure persons would benefit from that as well. Just a reminder for our audience in the room this morning that the session is definitely being recorded. We did say so at the start of the event, of the activity, that is being recorded. And can I tell you, Leah, I went over to our Facebook page and it is also very active. There is somebody that said, you know how long I want to know what some of these terminologies mean. So it is useful information. We hear them on the news every day, all of these keywords. And they talk about it, they talk about the inflation, the GDP analysis, but nobody stops to really provide clarity on what it really is. And I believe that if we understand what it is, sometimes we won't get so upset about it. You know what I mean? So thank you very much for sharing. We're gonna hand over to Shanique now so that she will just go ahead with what she has to say.
Hello, everyone. Good morning. Is everyone hearing me?
Yes, we're hearing you, but can you turn on your video for us, Shanique?
Oh, I'm allowed. Let me see.
Yes, I would love to see you. Yes, there you are.
Hello, everyone. So Leah has really been giving a very insightful and excellent presentation so far. You know, she's talking about setting your goals, and not only any goals, but SMART goals. So specific, measurable, achievable, realistic, and timely goals, right? So I'm just going to share some perspective as a senior client services representative. So for me, a lot of times when clients come in branch to open their investment account, they're like, wow, I really wanted to start investing from a long time ago, but I thought it would be $1 million. So when I tell them, no, you can start your investment with as low as $2,000, they're really surprised. And I'm really giving that insight because it's important for you to know your why and to treat investment in a very intentional way, right? So we all know our goals. You know, you want to save for your car, you want to save for your children's tuition, but you have to really be serious about it. And a part of doing that is going on YouTube, you know, see what investment is all about, calling the different brokers. I was giving some examples in the chat. And Barita, we are a broker here, and we're very excited to have new clients who are just serious about building generational wealth and wealth creation on a whole, right? So when you come in branch, don't be shy. If your goal is to buy a car in a year, to buy a car in 6 months, let us know so that we can assess your risk appetite. And I would have spoken about the different levels of risk appetite. You can be conservative, moderate, aggressive, whatever it is. We will meet you halfway and we will help you to come up with your investment portfolios. So just come in. I've been sending emails to a few persons in the chat. The energy is so great. And I'm just so appreciative of the engagement. Now that Analia is going to transition into wealth creation and not wealth creation, sorry, youth entrepreneurship, a big part of youth entrepreneurship is finding different streams of income, right? And a big part of doing that is finding out what your talents are and how you can maximize on that, and also investing. I was actually talking to Miss Darling in the chat, and she was saying, you know, I want to find a way to get some interest in my bank account while allowing my principal to grow. I was telling her it's possible. No, I'm telling everyone in case you missed that in the chat box. So you can come in, we can talk about your different entrepreneurship goals, right? And I'm just very excited to be here, and I'm so excited to hear more about what Analia has to offer. So just continue to engage with me in the chat box. I've been sending out the emails already, and I'm so excited to just call everyone so that I can talk about getting started with you. So yes, Analia, you can continue now.
All right, thank you very much. Time is of the essence, and so I'm just going to go to my very, very last slide. And yes, I'm going to go to my last slide, which just ties everything back together. So we will set up another time to go through your startup, look at your, for this, we'll look at your why, who, what, how, and when. So this presentation will definitely go through at a different time, talking about your characteristics, motivation, vision, the confidence that you have to keep you going, your passion, and your ability to make decisions. But at the end of all of that, what I want you to take away, well, let me look at this slide to Sancio. I'll be done in just a few more minutes. We want to look at some of the pitfalls to entrepreneurship. A big one is fear. A lot of times you start and you get afraid and you get nervous. Don't be, especially with young people. Youthful exuberance is something that should be a driving factor. As a young person, you don't have a lot of responsibility yet. You're not tied down with the woes of the world. Don't be afraid. Just push on. If it can be done, you can do it. Lack of focus, not reinvesting in the business. Sometimes you go into Jamaican businesses, you go into a medical facility and you look on the fan and it's full of dirt and dust. And you're like, oh my God, just simple things. Invest back in your business. You know, lack of discipline. You set the money aside to buy a printer and instead you use it and go buy a big lunch. That don't work out, right? Taking poor advice. Sometimes you go hairdresser, sometimes your mother afraid and your mother give you advice and you know it's come out of a place of fear and instead you reassure her, you take that advice. Lack of funding is a big one and one we have to look at, and poor financial habits. But you know, I will make the presentation available to you and I will come back to have the discussion. But one thing I want to point out with you is that in putting everything together for entrepreneurship, it's important to write a business plan. I was amazed that the JBDC offers so much help to participants. You can go to the JBDC website. There's a page here for, it has a toolkit where you can actually go and get so much information. You can go there and start your business plan. And the business plan it walks you through. Not only does it just give you a template, but it gives you direction. It's like a roadmap. telling you how to go here, how to get things done, how to write your mission statement, to bring your vision together so that you know you're inspired to move and you're able to sell it. And so people can invest in your business because of how you have things clear cut. And I just want to commend the team at JBDC for such an excellent model, you know, for doing something so wonderful and putting it on your website free of cost to your participants. It is beautiful and commendable. And I mean, I can't explain, I can't say that enough. So my last slide is how to tie it all together, right? Why, as an entrepreneur, especially a youth entrepreneur, why do you need to save and invest your money? And one, it is a healthy habit. If you make saving and investing a habit, it helps you in the long run. Getting involved gives you a better understanding of yields and returns. Just being out there, it helps your language. It makes you understand how money really works and what cues you need to take. It tells you about return on investment, and it makes you a keener business person. So even when you go out there, you have a better talk. You can understand what other people are saying, and you can express yourself. And this is important in any successful venture. So make saving and investing a proper habit, and it will work out for you. You need a positive sign. You need to give off a positive sign. So your saving and investment habits make a positive impact on stakeholders and investors. They realize that you as an entrepreneur are frugal and want to make every penny go a long way. Just like when you inspect, they can't inspect your venture at that point because you don't have a lot of groundwork yet, but they will look at your habits. You know, you can't have done much, but what they are closely able to see is your process and your mindset towards saving and investment. And it is a good reflection of your intention as a business person, and you're able to get funding, whether it is seed funding, whether it is partnerships, whether it is stock shareholders, whatever it is, you are able to get more people in on your venture once you give them a positive sign of your determination. For a freer mind, while you are busy building up your business, bootstrapping, getting everything together, you are also creating a kitty for yourself. No matter how small you start, in a few years, you'll realize you don't have to go out scouting for money to borrow to do every and anything, because you would have had a little bit put aside for yourself, right? And it can come around to help you, even if it's a small amount. Sometimes you say you want to put on big money, and because you don't get the big money, you don't reach anywhere. Saving for a rainy day. Savings and investments mean that you have something to fall back on when you are down and out. With smart saving and investment decisions, you can even buy out your investor. You remember the situation I tell you about the bicycle, the man with the bicycle? He was able to buy out his brother when his brother wanted to go to Canada, right? So it allows you to be able to buy out your investor when push comes to shove, and it free you up to start even another business or to expand your business, to innovate your business. That is what the power of saving and investing can do for you in your business. So it is very important for you to understand, after you work so hard and put in so much, that you will be sustainable and be sustained by the amount of money that you save and invest. So you see why it is very important for us to merge the two. So spreading the word is another benefit, because when you're in the office or in your business place and you talk about saving and create a culture of saving and investing, everybody gonna say, Lord Master, turn off the light because you know the boss mean already. And you know, so they will indeed save for you, because you create a culture of saving, and saving is contagious. When you talk about your investment, other people are going to want to buy stock too, and everybody in the office are going to buy stock, and you just create an environment that works best for you all, and you become all each other's keeper. So come in and chat with us. Our location, our main branch is at 15 St. Lucia Way in New Kingston. We have a branch in Montego Bay, 2 branches, Fairview and Bay West. We have one in Mandeville as well. So if you have any questions, I know you've been putting them in the chat, but now is the time for those. Thank you so, so very much.
Don't forget to put your emails in the chat box. I saw about 8 or 9. So yes, keep them coming.
All right, thank you so much, ladies. Thank you so, so, so much for coming on and sharing with us this morning. There are some presentations that we get an opportunity to do that require a part 2. This is one of them. So Analea, I'm going to be reaching out to you at some point, maybe later today or tomorrow, because we've got to do this. We've got to get you to do that youth entrepreneurship element of the presentation. The wealth creation part though was really, really, really interesting information. I want to thank you both ladies for coming in and for sharing with us this morning. Just a reminder, session was recorded. So if you know anybody that did not get an opportunity to join this morning, please direct them to the JBDC's YouTube page. It is at JBDC Jamaica. And once you get on there, just hit the little subscribe bell so that when new information is posted, you will be first to notified of it. Also want to remind you that we have posted our event feedback form in the email, in the chat. So if you can just take a minute, click on it. Analea has promised to share with us the presentation for this morning. I'm going to be sending that out via email today as well. Once I get it today, I'll send it out today. So thank you so much, ladies, for coming in and sharing with us this morning. Any final words before you go, Analea?
I just want to encourage everyone to get started. It is not bigger than you. And a dog and cat investments make for. It's for you and for me. Do not be intimidated. Too many times we hinder ourselves from propelling forward because we're afraid to ask questions. I don't know where as Jamaicans we get this timid personality from all of a sudden. Go out, ask the questions. Go on the different
all along.
I know, right?
Yes.
Go on the JBDC website, go on the Barita website, get the information, inform yourself, watch educational videos on YouTube, learn these things, and you will do better for it. We can build a better nation. This is not just only about building us, but building a better nation for our children and our grandchildren to grow up into. I thank you so much. I'm humbled to be here, and I really appreciate the opportunity to talk to you today. And it is my pleasure. Reach out to me anytime. I will be here to give you whatever assistance I can. Thank you so much for having me, Sancio. Thanks for all the participants, and thanks, Shanique, for giving me that support and backup. Thank you so much. It was wonderful for me too.
And for the persons who are typing their emails in the chat, just put some clap emojis and some thank yous in there if you're appreciative of the presentation this morning. It was indeed one of those presentations. As I said, we're going to look at the possibility of seeing how we can facilitate a part 2 as quickly as possible. Don't be afraid to reach out to Barita. Barita has been going on with some really big things of late. Everywhere you go, there's a Barita ad. You see the Barita ads on TV, you see them on social media, which means that they are serious about the creation of wealth in Jamaica and about youth entrepreneurship. We're happy to have partnered with them this morning, and we are so looking forward to what the future will bring for JBDC and for Barita together as we move forward in empowering our youth to get into entrepreneurship and, of course, in the creation of wealth, which is crucial for the future development of our country. So thank you so much for joining us this morning. And again, please remember, visit the JBDC website, www.jbdc.net. There's quite a bit of information on there. And of course, you can access the presentation on the JBDC YouTube page at jbdcjamaica.com. Thank you so much for joining us and have a great rest of the day.